Hello, fellow investors. This is InvesTips, and welcome back to another video. Today, we will be going over the 6 different market order types and when or how to use them. After watching this video, you will be fully equipped with the knowledge on how to use different types of orders. This knowledge will help you save a lot of money, enlarge your profits, and diminish your losses. Follow along to the end of this video to understand the fundamental order types of investing. Without further ado, let's dive right into the different type of buy orders. The first buy order is the market buy. This is where you agree to buy a stock at the current market value. Right? So, normally when people use a market buy, they're more concerned about the speed of their order and not much about the price of the order. So when should you use a market buy? Normally, investors use a market buy when they think a stock is going to explode soon. Right? So if a stock is going to explode soon, this usually means that you should hurry up and buy the stock as soon as possible so that you can catch on and still get the most profits that you can. Now, you should also use it when you think a stock is going to continue rising. Right, because if you've done your research and you think a stock is really good and you think it's just going to keep going up, then it's best to just buy the stock as soon as possible without doing a limit buy or a stop limit buy. So this can sometimes be risky because sometimes the stock is currently overvalued and will go back down, right? So it's best not to buy a stock when it's overvalued. The second type of buy is a limit buy, right? This is where you set a limit price, which is the highest amount you're willing to pay for an individual stock. Right? So normally investors use this type of buy when they're concerned about the price of the stock instead of how fast their order goes through. So take for an example a hypothetical stock, and currently it's at let's say it's at $100, right? So you think the stock will continue going down, so you set a limit price of, let's say, $90. So once the price of the stock hits $90, your order will be automatically filled. For example, if the stock goes up and then drops completely, right here at exactly $90, your order will be filled. So when should you use this type of buy? Normally, you would use it when a stock is extremely volatile, right? So if a stock is really volatile, you can buy it at a low price, and because it's really volatile, it'll probably go back up and spike up so that you can make profits. And also, you should use this type of buy when a stock is currently overvalued. Right? If a stock is overvalued or overpriced, then you believe it will go down, then you should probably set a limit buy instead of a market buy so that you spend the lowest amount possible. But you should be careful here because sometimes a stock will just continue plummeting, and even after you buy it using a limit buy, it will still continue dropping. So you should be careful and set a reasonable limit price. And also, you should do your research and make sure that this stock will probably go up in the long term. So when can this be risky? Sometimes it can be risky because sometimes the stock doesn't actually hit the limit price and will continue rising in the future and make you lose profits, right? For example, let's use this exact same stock, and it's at $100. And you set the limit price at $90 down here. Sometimes a stock will just continue rising and never hit your limit price, so therefore your limit buy will never be filled, and you lose out on a ton of profits. So be careful with this, and when you think you should use a limit buy, make sure you're reasonable with your price, and make sure that your limit buy will actually be filled at some point. Now the last type of buy we will be going over today is a stop limit buy. Right? So this is probably the most confusing one. So I wouldn't recommend it to new investors, but I'll still be going over it today. So what you do in a stop limit buy is you set a stop price which is above the current market price, and you also set a limit price. So when the stop price is when you want your order to be triggered, and the limit price is the highest price you're willing to pay for each share after your stop price has been triggered. For example, if a stock is currently at $100 again, and you set a stop price of $110 and a limit price of $125. Once this stock hits $110, your limit buy will be triggered. So now your order will turn into a limit buy. So as long as a stock is under $125, your order will be filled and you will have ownership of the stock. So this is usually used to ensure that a stock will grow in the future. Right? Because sometimes it's at $100 and it might just drop down to $80, and this, but if you set a stop limit buy and it hits the $110 mark, then this ensures that this stock is reliable, and if you've done your research, it probably means that the stock will grow in the future as well. So again, this is not the most simple buy order type, so I wouldn't recommend it to new investors, but it's still a useful type of buy that you can try out. Now that we're done with the buys, let's move on to the different types of sells. So the first type of sell is a market sell. Right? So a market sell is when you choose to sell the stock at the current market value. Right? So just like a market buy, you are more concerned about the speed of the order instead of the price. So this is usually used when an investor believes that a stock is going to plummet really soon. So this can also be used when you think a stock will continue to drop and will never rise again at a higher price. So a market sell can sometimes be risky because sometimes a stock is just it's only dipping a bit and will still grow in the future, and you can actually lose a ton of profits using a market sell. So for example, if there's a stock and it's dropping a bit, someone might want to market sell to get rid of the stock immediately, so they sell right here, right? So but this could be really harmful because in the future the stock could just be dipping and rise a lot more in the future. So be careful when you use a market sell, and make sure you think the stock is going to actually plummet really far or continue dropping in the future. Now the second type of sell is a limit sell. A limit sell is where you set the lowest price you're willing to sell a stock. Right? So normally when you use a limit sell, you're more concerned about the price and the amount of money for the order instead of the speed of the order. So for example, using another hypothetical stock, let's say a stock is currently at $100. You can set a limit sell for $125 so that when the stock price reaches $125 or higher, the order will be filled and you will have ownership of the stock. So normally investors would use this type of sell to secure profits. Right, so you could use a limit sell at a certain price so that you can secure your profits at that price in case the stock drops back down. So you should also use this stock because sometimes investors believe that the stock will rise to an extent in the future, but they think that the stock will drop after the rise, which is why a limit sell is sometimes really useful. Sometimes this can be really risky again because for example, if the stock never if the stock never hits the limit price and it continues to drop, then that means your order will never be filled and you could lose a ton of money like this. For example, again, you have another stock, the same stock, and it's at $100, and you set your limit price for $125. However, the stock never actually hits $125 and slowly plummets down to $90, and you lose a ton of money, and it could continue dropping in the future, and you will lose a lot of your money from this type of order. So when you think that a stock will drop, it's always best to use a market sell, but if you think that it's going to rise and then drop, then it's normally better to use a limit sell. Now the last type of sell in this video is a stop limit sell. So a stop limit sell is basically where you set a stop price which is lower than the current market price and a limit price which is the lowest price you're willing to sell your shares for. When the price of a share hits your stop price, it will trigger a limit sell and your order basically turns into a limit sell where when it hits your limit price or higher, you will sell that stock. For example, if you had a stock and it's currently at $100, you can set your stop price at say 95, and then you can set your limit price to like 98. So when the stock hits $95, your limit sell will be triggered, and now your sell is a limit sell. So when it hits $98, you will immediately sell that stock to prevent you from losing a ton of money. So when should you use this type of sell? Normally, investors use a stop limit sell to cut losses so that when the price drops low, you don't lose all your profits when it continually drops, and then so you save yourself from all these losses. So that is a stop limit sell. Again, this is still quite complicated, and it's not the best order type for a new investor, but it's also still a great and useful order type that more experienced investors can try out. Alright, that is it for this week's video. Thank you very much for watching. Please consider liking and subscribing. It really helps the channel out. And also, it would be great if you could check out a website called Wealth Simple Trade. It's a really easy to use investing app. I'll leave my referral code down in the description below. Again, thanks for watching, and I'll see you again next time.